Mortgages 101. So we're going to start with the basics of mortgages. Okay, so let's start with basically what is a mortgage. So a mortgage is likely to be your largest and longest term mortgage loan that you'll ever take out. And it's going to be to buy the biggest asset that you'll ever own, which is your home. The reason why it's the longest term is usually mortgages can stretch out over an amortization of 30 years. So that's basically how long the lender gives you to pay off the mortgage. So you do have a long time to pay it off, and they amortize the payment over that. So the more you understand about how a mortgage works, then the better you'll be to have decisions to select the mortgage that's right for you down the road. So a mortgage is a loan from a bank or a lender to help you finance the purchase of a home. When you take out this mortgage, you make a promise to repay the money that you've borrowed, plus the agreed upon interest to the lender. The home is then used as collateral, which is the security, which means if your payments go behind, you're into arrears, the bank or the lender does have, your home as the security, and that's what they would unfortunately take back. But this is going to be some tips onto how, to keep your credit up and make sure that doesn't happen. So your loan does not become a mortgage until it's attached to the lien of the home. So that's when you actually secure, everything closes with a lawyer and everything is done that way. So the basics of how to get a mortgage, the steps are fairly simple. So at any time, you should always be checking your credit. So there's all these sources now that you can get credit alerts, that you can go in and check your credit just to make sure that your score is good. There could be something that reports on the credit bureau that's not correct. So you always want to make sure that you are checking your credit to make sure that everything is accurate. Because it is important to have a higher credit score, 680 plus, would be ideal in order to qualify for a mortgage. And then as early as you can, you do also want to be saving for the down payment, which is the money that you have to put towards the home, and then the bank will lend you the rest. So minimum down payment is 5%. So the earlier you can start building up a savings plan, the better for that. Then you also, this actually might be in the wrong order, you then want to speak to a mortgage specialist first to find out the amount that you would be able to be pre-approved for, and then start looking for the home that you're looking at, the area that you want to look in, your desired home. And it's also best to use a real estate agent if you can, because they will help you in the process, especially if you're a first-time home buyer. And then you also want to put together the required documents, which would be down payment confirmation, income documents, which would be pay stub, letter of employment, those things, in order to have everything ready so that when you do find the home that you want, you're prepared and the lender can check all of your credit. So there's basically what we call 5 C's of credit, which are credit, capacity, capital, character, and collateral. So these are the things that the lenders look for in a client before they will extend them any credit. So before they will approve them for a mortgage. So just a summary of each of those. And the earlier that you can start making sure all of these things are in place, the better for you down the road. So credit, which I touched on earlier, is the first thing. So credit shows the lender a snapshot of your repayment history over a period of time. So this is the only way that the lender can predict how you will make your future mortgage payments, by basically looking at your past. So your cell phone bill will show up on your credit bureau, any credit cards, a car loan, all these things are what the lender will use to check your credit. So it is important that you're making sure that your credit is good, you've made your payments regularly to maintain a good credit score. Capacity is the ability to repay the loan. So that is your like income. So you have to have like the ability to be able to afford the payments. So you also have to have that. So depending on your job, how much money you earn, those things, that's your ability to show that you can repay the loan. Capital the amount of money that you have to put towards the loan yourself. So capital would be, like I said, saving for a down payment, because they want to see that you also have money that you're willing to put towards the mortgage. So the more capital that you have, which is savings, net worth, everything like that, is a strength to the mortgage. So we'll talk about a little bit of ways to how to start saving and build up your capital. Character is basically just your general trustworthy to repay the loan. So factors like length of employment, the ability to save, how the credit cards can be used, all these things work together to show your general character. So again, just savings, it's not just necessarily how much you save for the down payment, but do you have extra savings? Have you paid off a car? Have you paid off a loan? Things like that. And then collateral is the actual home itself. So the lenders will look at that. That is important. Sometimes the area that you're buying, sometimes if there's an older home and the electrical, there's something wrong with the electrical, lenders will look at all of these factors because at the end of the day, that is their security, that's their collateral. So the home that you're looking for is another criteria that the lender does look for. So some important tips, as I said, so just to keep your credit good from the beginning. So as early as your first cell phone, a lot of people don't realize that that does show up on your credit bureau. So that is important. Your first credit card, I know when I walked into university the first week, they were just handing out credit cards and I'd never had one before. But you have to make sure that if you use it, you pay the minimum payment due every single month. Just in terms of savings, so I know people think it's a daunting task, I can't afford to save, but just saving the cost of a cup of coffee a day can build up over time, and you don't even realize how quickly that can happen. But it's very easy to go to Starbucks every single day, but if you took that $5 or however much a coffee costs and you put it just towards a saving, in a year, that can build up to $2,184. And that's not even including interest. So you would also put that into a form of an account, like an RRSP, a TFSA, something like that, where it's earning some interest and growing. So if you can save $2,000 in 1 year, in 5 years, you've gotten that up to over $10,000 and so on. So it compounds and it's a little bit each day, but it does build. Another thing to note when you are looking for a mortgage is the amount of payments that you have, whether it's a loan payment or a car payment. For example, a car payment of $578 will reduce your mortgage buying power by $100,000. So if you have a car payment outstanding, that takes your mortgage approval from say $500,000 to $400,000, or from 4 to 3. So it lowers your price point quite significantly. And I don't think a lot of people realize what just a small payment can do. The other thing is when you do start working, even if it's a part-time job initially, is just take a portion of your pay. We usually call this the pay it yourself first rule. And if you take 10% of what your paycheck is, try to put that into a savings and do it automatically. If you get paid every Friday, every other Friday, go into your bank and say, hey, on the day that I get paid, I want to take 10% out and move it into a separate savings account. Something that's not linked to your debit card, something that you can't easily access. And again, that will grow over time and help you with the down payment. That is one of the hardest things that people have to do, is to try to save that money for a down payment. So the earlier you can start, the better it is for you. The other thing is keeping credit card balances high. So if you have a $500 or a $1,000 credit card and you keep it close to the limit, so you have 500, you owe 500, that brings your credit score down dramatically. Even if you are making your monthly payments every month, just the fact that you're using it and using it with a high utilization rate is what the creditors call it. If you have a high utilization, that brings your score down. So I'm just trying to give you some tips on how to keep your credit in good standing. And then again, any missed bill payment. So you might think, oh, I can just miss this bill payment and I'll just double up next month. I've still made my payment. I just made it twice, like in the next month. Unfortunately, it doesn't work that way. That's not how creditors look at it. As soon as they see one missed mortgage payment, even if you've paid it off completely the following month, that does bring your credit score down. So those are just some small things to keep in mind that can help you with a couple of the C's of credit, which is the credit and the collateral. So just keeping your building for your down payment. So the next slide is just to give you like getting a mortgage versus renting. So a mortgage, you own the property. Renting, you never own the property. So when you have a mortgage, you own the property, it's a good long-term investment. So the monthly payment you are making pays down your mortgage, which is building equity. So now this is an asset that you own. If you rent, you're paying these payments, but you're not building any equity, and you don't have an asset at the end of the day. There are federal tax benefits for first-time home buyers. So the government does give some incentives to people to buy homes. So look into that, take advantage of federal tax incentives. You can save into an RRSP, and as a first-time home buyer, you can withdraw from that RRSP towards your down payment, tax-free. You do have to pay it back over 15 years, but that is one of the only ways that you can withdraw from your RRSP and take advantage of that tax-free. The mortgage payments are steady. Like, you know, if you set into a term of 5 years, that will be your payment for the 5 years. Rent may increase. Your landlord may decide to sell the house and then you have to go somewhere else. There's just not a lot of stability and consistency with renting as there would be if you owned the home. A lot of times renters don't let you do, the landlord, don't let you make changes to the property. You know, landscaping, renovations, things like that. Whereas when you own the property, you can choose to do whatever you'd like with it. So as I said, you aren't building any value, you aren't building any equity, there's no asset if you are just renting. So that's just some tips about mortgages versus renting. So here's some ideas about home ownership. Perhaps like you're living at home, you can live with your parents, and you want just some other ideas about home ownership. It doesn't necessarily have to be your first home. You can purchase an investment property if you have the ability to still live at home. You can purchase a property, live at home, rent it out, and then have your renter making rent payments, which in turn pays the mortgage down for you. And then you've now built equity in this home. And then when you're ready to, you can, have the tenant leave, and then you can move into the home and your mortgage has been paid down for you. Another idea is, a lot of people will rent with a friend perhaps or a roommate. But you could also look at buying a duplex or a home with a friend. And then that way you're living in one unit, your friend's living in the other, or you can rent out the other. You live in one, you rent out the other, and that person's paying you rent, which is also helping pay down the mortgage and build the equity. So if you are going to live in a duplex to use as an investment, you can also, if it's owner occupied, buy that with as little as 5% down. So there's another way to, start investing and use that as a mortgage as well. So here's just to break some costs down and what things look like. So as I said, minimum down payment, 5%, regardless of the house size. So say you have a listing price of $299,900, call it $300,000. The minimum down payment that you would have to come up with is $14,995. So the earlier you can start saving for that, the better. Because if you can start with your first job, start putting some money aside, because once you do start renting, if that is your first choice, it's very hard to now put some money aside because now all your money is really going towards the rent and there may not be extra money there. So just to give you an idea of what the cost is for a down payment. So then there's property taxes that you do have to pay. Depends on the property itself, but that's paid to the city. Then you get an interest rate. So rates actually right now are very, very low. So call it 2.29. And then it's a term of 5 years. Could be 1 year, 2 years, up to 10 years. You choose the term that you want to go with. If you do put less than 20% down, the amortization, which is the total length of time required to pay off the mortgage, is 25 years. If you can put 20% down, then you can amortize it over 30 years. So the monthly payment on this example would be $1,427, which is probably less than you would find as a rent cost right now. If you can come up with the 20% down, again, the earlier you start saving, the easier it is to come up with the 20% down, which is almost $60,000 on $300,000. Your monthly payment is only $1,180, which is definitely cheaper than finding a house to rent right now in Hamilton. So this just gives you, again, some ideas, puts things into numbers, gives you a picture of what you would need to have in order to be able to find a house. So again, this just tells you how important the down payment is in getting saving for that down payment as early as possible. So some of the things I touched upon was the RRSP, first-time home buyers. So an RRSP is a registered account designated to help people who earn income from a job or a business build a nest egg for retirement. But you can, as I said, withdraw that RRSP under the first-time home buyers plan as a down payment toward the home. The RRSP itself can hold different types of investments. So you can have guaranteed investment certificates, term deposits, mutual funds, stocks, depending on your risk level. And those will grow. There's interest earned that grows over time, tax-free. And then when you are ready to buy the house, you can redeem it. The TFSA is another tax-free savings account. That's another vehicle in which you can save money. Again, the money saved earns tax-free. You don't have to claim it on your income tax. It also will allow you to hold GICs, stocks, mutual funds, all those types of investments. And then when you withdraw the money, it's tax-free. That can go towards the down payment on a house. So again, back to what I had said before, if you were to take $6 a day that you likely spend on a coffee at Starbucks, put that into a savings account in 1 year, and that's not using any interest. In 1 year, you've got $2,184. So do that over time, start earlier, 5, 10 years, you've got that money to buy that house, that down payment. So some of the things, some books to read, just as if you're interested in, they will help you with more of the savings and how quickly the savings will build to the down payment. So 2 strategies that I talked about was the coffee, so saving the amount of a coffee a day, or taking 10% of your pay and transferring that into an automatic savings plan. So a couple books, The Automatic Millionaire, The Latte Factor, The Wealthy Barber. They're all good books regardless of what your plan is, whether it is to buy a house or not. It's just a great initial read, gets you looking at investing and talks about mortgages a bit as well, real estate as an investment, those types of things. So that's pretty much what I have in terms of mortgages, 101. There is just a contact page for us, if anyone wants some extra information. But like I said, we are going to go into some questions if anyone has any.
What are the risks of making a down payment below 20%?
So I wouldn't call them risks. I wouldn't say risk to it. I would actually, the downside is if you do buy with less than 20%, you have to get the mortgage insured. by CMHC, or Genworth or Canada Guarantee. They're companies, it's a government regulation that anything less than 20% does have to be insured, and they do charge a premium on that. So if, for example, you only put 5% down, they charge a premium of over 4%. So your mortgage ends up being almost your purchase price, essentially. So there's not that much equity in the beginning. But I mean, the time it was going to take to save 5% versus 20% is minimal. So, and to wait and not get into the market, that's another risk. If you're trying to wait to save 20%, you could be losing 1, 2, 3 years of getting into the market. And the way the house prices are increasing, 8, 9% per year, it's going to take you even longer to save to get in. So you would, as soon as you have the 5%, I would suggest trying to get into the market.
The pros and cons of the first-time home buyers program?
So I don't see any cons to the first-time home buyers program, really. Being able to save in an RSP, one, gives you a tax credit. So when you're working, putting money away into an RSP does give you a tax credit. Or if you save into another vehicle and you put a lump sum into your RSP, it gives you a big tax credit, which you can also use towards the down payment. And then being able to withdraw that RRSP one time only, tax-free, instead of being clawed back, 30%, gives you more money to put towards the house. So I think that's actually an advantage of taking advantage of the first-time home buyer credit. The other thing is the land only as first-time home buyers, you do get a credit on land transfer tax as well. So that could be savings of up to $4,000 or $5,000. So being a first-time home buyer is the biggest advantage that anyone has. Once you're not a first-time home buyer, you're moving on to your second home, you have to pay full land transfer tax. You're no longer able to withdraw from that RRSP tax-free. So I don't see any disadvantages to first-time home buyer programs.
What's some good resources for calculating your mortgage?
You can, I don't actually know off the top of my head, but you could Google, like you could even just put in a Google search, what mortgage would I qualify for? What would my payment be? I do know that, like, for example, Scotiabank has a resource on their website that you could just search up and you'd be able to put in like your monthly payment, your monthly income, what payments you have, and then they'd be able to property taxes on a potential property, and then it would come back with just a calculator saying what you would qualify for. There's also some apps, Canadian Mortgage app. There's an app you can download on your phone. I can give you some of these resources if you wanted to. You can have that on your phone, and again, you can plug in different numbers and it will give you the information. But anything on a Google search, anything that's linked to a bank or CMHC, that CMHC actually has a website. So anything linked to a bank, I would say, CMHC, a government site, those would be reputable and you would know that you're getting the correct information.
Amortization briefly?
Yes, so amortization is the total length of time that you have to pay off your mortgage. So as I was explaining, there's 25-year amortization, 30-year amortization is the maximum that you can have. So the way it works is they take your mortgage amount, the interest rate, and basically spread that out over 30 years, and then that's how they determine your monthly payment. If you're if you're buying with less than 20% down, your amortization maximum is 25 years. So your payment would be a little bit higher, but that's the maximum amount of time they can stretch that payment over in order to set your payments. The term is different than the amortization. Most times you'll see a 5-year term. That just means that if you get a 5-year term at an interest rate of say 2.2, you only have that rate for the 5-year term, and then it's going to come up for renewal, and then you're subject to whatever rates are at that time. But then again, your payment's still stretched out over that 25-year or 30-year amortization.
If someone is moving back to Canada, is it advisable to buy if they have the down payment, or should they just rent?
Yeah, I mean, if you have if you have the down payment, if you have a credit established in Canada, so I don't know how long they've been out of the country, but if you have down payment in a Canadian institution, if you have credit established in Canada, and if you're earning income in Canada, then, and you have the ability, I would definitely suggest buying versus renting for sure.
The difference between an RRSP and a TFSA?
So with an RRSP, when you put money in, it's a tax deduction. So if you earn $30,000, you put in $5,000, that $5,000 sort of reduces your income. So then you're only taxed on $25,000 of income. So you're putting basically pre-tax dollars into an RRSP. When you withdraw it, not for first-time home buyers, just when you withdraw it, which is supposed to be in retirement, it's taxed. Now it becomes taxable income to you. But the money stays there and grows tax-free. A TFSA, the money that you contribute to a TFSA is after tax dollars. So you don't get any tax advantage initially by putting money into a TFSA. So it's basically on your net income that you would be putting money into a TFSA, but the money also grows in there tax-free. And when you would withdraw it, it's tax-free. So there's no tax implications on the other side, but you're not getting a tax advantage when you put the money in. So I hope that answered that question.
Is any of them mandatory?
No, not at all. No, you don't have to invest in an RSP or tax-free. You could just open up a savings account. You could just invest directly into what we call a non-registered account, which would just be, doesn't have to be RSP or tax-free. Any sort of savings plan would work.
Which one is better for long-term savings?
Okay, so that's a tough question because it does really depend on someone's income situation. If you're in an income situation, like if you have a really good pension, for example, a teacher, a police officer, something like that, a hospital worker, something where you have a good pension plan. So in retirement, you're going to get an automatic pension from your employer. You may not want to invest so much into an RRSP because when you retire, the goal is when you retire, you're supposed to be in a lower tax bracket. So when you're redeeming from the RRSP, you're redeeming at a lower tax rate. But if you've got a really good employer pension, you're going to be still making pretty good money in retirement. And now you're forced to start redeeming from this RRSP, which can then put you back up into a higher tax bracket. So it's not really a straightforward answer. It does depend on the individual specifically. But I would say, like, yeah, it depends. If you have no pension plan in your work, which a lot of people don't, they move from job to job. So if you don't have any sort of pension plan, then I would recommend investing into an RRSP because that sort of becomes your pension.
If you have bad credit, how can you build it up to get a mortgage?
Okay, so yeah, definitely. Like people will have bad credit with missed payments. High utilization will bring up the, bring down the credit score. So a couple things you can do. Say you have like 4 or 5 credit cards and they're all sitting at the limit. Go to your bank and try to see if you can get a consolidation loan, or see if you can get like a line of credit. Pay off all the credit cards, put them into one loan that has a fixed monthly payment. As soon as you do something like that, within probably 4 to 5 months, you'll see your credit score start to go up because now your credit cards are down to a 0 balance. There's no more utilization issues. Just make sure you're making that monthly loan payment. So that's a quick way to improve the credit. If it's been missed payments, you just have to make sure you continue to make your payments on time going forward. And then the older those missed payments are, the more your credit will start to increase. The other thing which I didn't mention is a lot of people think having no credit is good as well. Like, oh, I don't believe in credit cards. that's actually kind of a downside. So you really should have two trade lines, so two things reporting on your credit bureau, because the lender needs something to look at to make sure that you can, that you've proven that you make payments in the past. So it is important to have credit, it's just to use it properly. So if you have no credit, that's also not necessarily a great score. Having at least two credit products paid properly will also increase your score.
What if someone can't necessarily keep up with the current home market? What can they do? What are some options for affordable housing?
So there are some like, are they talking about like the down payment initially? Yeah. Okay, so there are some government programs that you can apply. CMHC has put out, and they will, if you can save yourself 5%, they will give you an additional 5%. Now they do get some ownership in the home, but they will kind of match your 5%, which could help you qualify. The downside of it is when you go to sell the home down the road, that has to be paid back. But it's not 5%. It's not just what they gave you. It's 5% of the gross value of your home. So you lose some of your equity. But I mean, if it's important to get into the home initially, I mean, that's the way to go. If you can get an RRSP loan, a lot of the banks offer those, like an RRSP loan. So you can apply for a $20,000 RRSP loan. That means you get a lump sum of $20,000 that you can put into an RRSP. As long as you can make that loan payment, you can use that $20,000 towards down payment as well. The other thing is, like I said, like try buying it with somebody. Maybe, you know, you can buy it with somebody and you guys can, you know, split it and then each make the payment, like a duplex situation where you're each contributing to the mortgage payment, or buy one on your own and get a renter in there if that helps with being able to afford it. I think those are just some of the things, like, yeah, like the earlier that you can get into the market, the better. There are some lenders that will do a flex down. Now, they're very hard to qualify for. You need to have excellent credit. You need to have a really good income. But those are programs through CMHC as well, where basically, like, you don't even have to have the 5% as long as you could kind of qualify without it. But that premium gets added again to the mortgage. So it's not really something we recommend. You try to have your 5% down. But yeah, I would say, like, even buying with a partner, if you have a parent that can co-sign, something like that to try to get you into the market.
How much of your monthly income should you be putting towards a home purchase?
So how much of your income should be going to a mortgage payment?
For
the down payment.
For the down payment, yes.
Okay, so I'll answer both just in case. So as I said, if you can start, like when you're just starting to save, if you can put 10% of your income away, your take-home income, if you could take 10% of that income away, that's the general rule of thumb for savings. Now, again, it depends on what kind of house you're looking for and how much of a down payment you will need. But if you can start with just that 10% of your net income and put that away right away before you get to spend a dime, like pay yourself first, we call it. So as soon as that money hits your bank account, 10% goes out into another investment vehicle. If you're asking about how much of your monthly mortgage payment should be your income, it's about 32%. We don't like to see, and that's not mortgage, it's mortgage, property taxes, and we always use a utility cost. Your heating, your mortgage, property taxes and your heating should not exceed 32% of your monthly gross income. We don't want to see anyone be house poor. Like, you don't want to put, you know, half of your income towards a mortgage payment. So that's why we got guideline around 32%. What's
the best place to get your mortgage approval from? So where should people be going for that?
So, okay, so it depends. Like, I mean, there's banks, there's credit unions, and then there's basically, like, you could go through a mortgage agent. So the benefit of going through a mortgage agent is it's like one-stop shopping sort of thing. So we have access to the banks, the credit unions, and then other lenders called monoline lenders that just specialize in mortgages. So it's like just going to one person, they take your application, coach you onto getting the house, and then they shop the mortgage around for you. So we have over 30 different lenders that we can use. And we will find the best rate for you and find the best product for you. If you go to just one bank, then you're only able to get their rates and their products, which might not be for you. So that's just what I say. Those are your options. If you can use someone to do the one-stop shopping for you, that would be better. The other thing with, and everyone's doesn't have a lot of time, so you don't want to go from bank to bank to bank to bank. The other thing with that is if you go from bank to bank to bank, each of those banks is going to likely pull your credit. The more credit pulls you have, that is also a knock on your credit, which brings your credit score down. So if you're trying to maintain good credit, you don't want to be shopping around and having 20 people pull your credit. Whereas if you go to a mortgage agent, they do all the shopping around for you, and it's one credit pull. We just do the one, and then we shop it to all the different lenders. So again, if you have a good relationship with someone at your bank, I'm not going to say don't use them, but that's another thing. You kind of want to make sure you fit with the person that is helping you with the mortgage, because it's like a relationship, because they're going to be helping you along this path. So if you do have someone at the bank that you're a strong relationship with, someone that you trust and knows has your best interest, then by all means use them. But I would say, and a lot of people now with first-time home buyers, they're doing a lot more research online. No one really wants to go into a bank anymore. Like, we don't even have to meet with a client if you don't want to. Everyone's got busy schedules. We can do things over the phone, through email. There's electronic signing we can do. So we can make it as convenient for the client as possible. So I would say start with finding someone that you trust. Google, like search if you've been referred, or if you know someone, just search them up, see what their reviews are like, see what other people are saying about them. That's a good way to start too. So I do suggest, and I worked at the bank, so I'm not putting them down at all. Like, I worked there for 17 years. You just have more options when you work with an agent, because they've got 30 plus different lenders that they can work with.
Does having a life insurance help with getting a good mortgage?
Having life insurance?
Yeah.
Unless it's a policy that you can redeem from, it wouldn't really help as an asset or anything like that. There are policies, whole life policies. I don't know, exactly how they work, but I do know that some of them have a surrender value where you could take out some money from them. That would really be the only way that it could help you, is if you are able to take some money out to put towards the down payment. Just having a life insurance policy in general, would protect your family or someone else should you pass away. Then they can use the funds to pay off the mortgage, and they're not left with this burden of having this payment. But in terms of actually qualifying and getting a mortgage, the only way it would help would be if there is some sort of cash value to it.
In Canada, can rental payments be put on the credit score to help prove your payment ability?
So rent payments are not reported to the credit bureau. That's not something that automatically can get reported and help your credit score. Now, we do have some lenders, though, again, that will say take like 12 months bank statement. If you have been paying rent, they may say, okay, can you send me 6 months bank statements to show that they've been consistently paying this rent without any NSFs or anything like that. So that would just be dependent on the lender. Like, they may want to try to help to get this mortgage and will request that extra document. But unfortunately, it's not something that does report on the credit. So it doesn't help to build the credit at all by renting.
Is the housing market expected to come down? Do you think this is?
So it's interesting. So CMHC recently made some changes to some of their guidelines in terms of qualification. because they actually came out and said they are expecting the house prices to decrease 9 to 10% in the later half of this year, early next year. So that's why they made these changes they put in place, kind of sort of making it harder to buy. Now, the other two insurers did not follow suit and did not make those changes. I guess, I mean, I don't know if the question is kind of COVID related. So there is some, speculation that the market, we haven't seen the effects of COVID yet, and the market will come down. But so far, like, we have not seen it. Like, houses are still going into bidding wars. The house prices in Hamilton anyways, some surrounding areas are different, but the house prices have still continued to go up. Not as drastically as they had in years past, but they have still gone up. I don't really believe that we're overinflated in house prices in Hamilton. I do believe there is some competition and houses go over asking, but that's not the norm. So I feel like the house prices in Hamilton are pretty fairly priced, and I don't believe that we will see such a sharp decrease like the 9-10% that CMHC is saying. If anything, we may not continue to see the increase. So it might just be flat or not increase as much, but I don't anticipate this decrease. And I think that's a lot of people speculate, oh, it's a bubble, the market's going to come down, I'm not going to buy yet, I'm going to wait till it comes down. But I've honestly been hearing that for the last 10 years, and there's been no drop. I've been in it over 20 years. And aside from just a few, like we had a decrease in 2018, so aside from just a few small, months in the road, overall, there hasn't been any sharp decreases. And if you're just waiting on the sidelines and you don't want to get into the market because you're waiting for that decrease, you're likely just going to get priced out of the market and never be able to get in. So I just always recommend getting in as soon as you can, because if you're trying to wait for that decrease, I don't think it will come.
And that's the last question.
Okay, excellent.
That was our final question. Thank you so much for joining us, and I learned so much, and I'm sure based on how many questions we got, I'm sure everyone learned a lot too. So thank you again for joining us. And thank you to everyone who came in and participated. It was great. I loved getting your questions. If you would like to rewatch this, we're going to be posting it on YouTube. It's Mo Money Mohawk College. And you can also follow us on our social media. It's on Instagram, on Facebook, and you can check out our website,